Hey there! In this video, we'll dive into Pfizer's financials, long-term performance, competitive position, as well as its challenges and opportunities. Stay tuned as we explore the details. Pfizer is a global biopharmaceutical giant involved in the entire life cycle of drug development, from research and development to manufacturing and marketing. Its products range from vaccines to oncology treatments, and the company frequently grows through acquisitions, adding new drugs to its portfolio. Geographically, Pfizer's business is spread out, with 46% of its 2023 sales coming from the U.S., 20% from developed Europe, and 21% from emerging markets. These markets provide Pfizer with both stability and growth opportunities, particularly in emerging economies. One of Pfizer's competitive advantages is its world-class research and development, consistently delivering innovations that drive future revenue. As of 2024, Pfizer had 113 projects in its development pipeline, with significant progress in the registration phase. This means Pfizer is constantly moving closer to launching new treatments. Another competitive advantages are its wide known and trusted brand and its diversified product range, which is 5 products with over $1 billion a year of revenue. Let's talk about Pfizer's stock performance. 2024 has been a tough year for the stock, with a massive drawdown of nearly 60% by April. This is unusual for Pfizer. For the last 20 years, its stock typically faced drawdowns between 30% and 40%. Investors now wonder if this marks a temporary dip or a deeper issue with the company's fundamentals. This sharp decline might present a buying opportunity if you believe the stock is undervalued. However, it's important to consider the reasons behind the drop, which we'll explore as we dig deeper into the financials. Let's take a closer look at Pfizer's long-term financial health. The company's revenue dropped significantly to $58 billion in 2023, down from its pandemic-era highs of $100 billion in 2021 and 2022. These declines are mostly due to reduced demand for COVID-related products, which had inflated earnings during the pandemic. Similarly, Pfizer's operating income fell to just $5 billion in 2023, the lowest it's been in a decade. Net income followed the same trend, coming in at $2 billion. These lower earnings indicate that Pfizer is transitioning back to its pre-pandemic revenue levels, but the drop has been more dramatic than many expected. Pfizer's return on equity is another concerning metric. In 2023, the ROE was just 2.3%, far below the company's 10-year average of 17%. ROE measures how efficiently a company uses shareholder equity to generate profit, and Pfizer's current figure suggests declining efficiency. But that's not the whole story. Adding to these concerns is Pfizer's growing debt load. Its debt-to-equity ratio now stands at 1.56, meaning the company has $1.56 in debt for every $1 of equity. This is a significant increase from previous years, indicating that Pfizer is relying more on debt to finance its operations. Its debt-to-operating income ratio is also rising, currently at 18, which means it would take 18 years of current operating income to pay off its debt, a concerning trend. But that's not all bad news. Despite its challenges, Pfizer has maintained a healthy dividend yield of 4.2%, one of the highest yields it has ever offered. For income-focused investors, this could be an attractive feature, providing steady returns even in difficult times. In terms of valuation, Pfizer's price-to-earnings ratio, or PE, ranged from 14 to 28 in 2023. A PE ratio of 14 suggests that the stock may be undervalued compared to its earnings, while a PE of 28 indicates higher expectations for growth. The wide range highlights the market's uncertainty about Pfizer's future performance, so it's essential to stay updated as these numbers evolve. So, where does that leave us? Pfizer is facing significant challenges, but it still has strong competitive advantages like its R&D pipeline and brand power. The company's financials may be under pressure, but its dividend and valuation could offer opportunities for investors who believe in its long-term potential. Keep an eye on the latest financial numbers and compare them to this historical data to get a clearer picture. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and drop a comment below about the next stock you'd like to see here. See you in the next video.